Good morning or good afternoon, depending on where you're joining us from. Welcome to today's webinar, which is an Unemployment 101 session. My name is Nicole Korn, and I'm the director of our unemployment solution here at 501c Services. Couple of housekeeping items today. There is a copy of today's presentation. You can find that located in the resources section of the webinar. Also, I'm going to leave everybody on mute just to keep down any background noise or distractions. But if you have a question at any time during today's webinar, you can type your question into the Q&A box, and I will stop periodically throughout the presentation to check those. Otherwise, write down my email address, and if you prefer to send me a question offline, I'm happy to do that as well. If you're joining today's webinar because you're in search of continuing ed credits for either SHRM or HRCI, in order to get the code to get those certifications, you just need to fill out the survey that you're going to receive at the close of the webinar. So give it a little time, but eventually you'll get a survey. Once you complete that, you'll have your information that you need within 24 hours for those credits. All right, so let's talk about the agenda for today's training presentation. First, we're going to start off with a brief history of how the unemployment program was formed and structured. It's going to be very foundational information. Then we're going to move on to chargeability and liability and how the state determines those things. Then we'll move on to the types of separations and some adjudication strategies, and we'll wrap up with some quick tips for appeals and hearings. All right, so let's dive in. Unemployment actually all began with the Great Depression. So 1929, the U.S. financial institutions collapsed. They had to lay off a bunch of workers, and this caused the unemployment rate to skyrocket to nearly 25% nationwide. So it was this event that prompted our government to try to find a way to provide relief to individuals who had lost their livelihood. So in 1935, President Roosevelt signed the Social Security Act, and that act contained provisions for elderly insurance, welfare, and unemployment insurance. Now, the unemployment program is federally mandated. However, the individual states are free to administer the program as they wish, so long as they meet 4 federal requirements. So the first federal requirement is the replacement of lost wages. So obviously the main objective here is to protect workers from a loss in wages. And while the weekly benefit amount may vary from state to state, unemployment is always meant to only replace a portion of a worker's earnings. So for example, if a worker makes $1,000 a week while they're employed and they get laid off, they're not going to receive $1,000 a week in unemployment benefits. And this is in part to provide an incentive to that unemployed worker to return to the workforce. Generally speaking, it's usually about 50%, 50 to 60% of their average weekly wage, up to whatever the maximum threshold is in your particular state. The second federal requirement is stabilization of national employment, and this objective creates an incentive to the employer to retain their workforce by taxing or charging them on their prior unemployment experience. So if an employer has a high level of chargeable claims against their account, their tax rate is going to be much higher than a company with little unemployment activity. Now, this is slightly different for nonprofits that are exempt from the taxes, but the underlying principle is the same. There is a financial impact for not retaining your workforce. Third requirement is stabilization of the national economy. And so the objective here is to help retain some of the consumer purchasing power, right? So no money in means no money being spent out in the economy. So that's an important objective. And then the last federal requirement is job placement. And this is actually why the state unemployment agencies are the primary job placement bureaus in America. So outside of these 4 federal requirements, every state administers their own program. And this is why regulations regarding eligibility, benefit amounts, and the length of time that someone can collect is going to vary by state. However, when it comes to eligibility, there are 5 criteria that are actually consistent in all states to be eligible to collect unemployment. you must be physically able to work. So able to perform some type of work. You can't be on disability and collecting unemployment benefits. You must be available to work. So you can't be in school full-time or backpacking through Europe. You have to be available if you're drawing benefits. You have to be actively seeking work. And so this is why the states, if you've ever filed for unemployment benefits, you know you have to check in with them periodically to prove that you've been looking for jobs or applying for jobs. You have to meet the state's monetary requirements. That just means you had to have worked long enough to be eligible, right? You had to have been in the system and earning enough wages to be monetarily eligible. And that minimum threshold, of course, varies by state as well. And last but not least, you must be unemployed through no fault of your own. This last one is the backbone of the entire program, but it's very subjective. So more on that when we get to the different types of separation and adjudication strategies. Okay, so believe it or not, the unemployment program really hasn't changed that much since 1935. That was until President Obama passed the Trade Adjustment Assistance Extension Act of 2011. This was major legislation, and it resulted in new regulations to promote unemployment insurance integrity. These new regulations went into effect in 2014 and changed the way that employers need to view their role in the unemployment process. Previously, employers made a choice between responding or not responding to unemployment claims and would often only respond if their wish was to have benefits denied. But moving forward, employers are actually required to respond to all claims in order to remain in compliance and avoid financial penalties. This federal legislation basically stipulated that the state unemployment agencies must prohibit relieving an employer of unemployment charges when both of the following conditions exist. One, the unemployment benefits were improperly paid due to a failure of the employer to respond timely or adequately to the state's request for information. And two, the employer has established a pattern of responding sufficiently and timely. So what's a pattern? It varies by state, but generally speaking, it's like either 2 instances or 2% of your claims in the prior year. So it doesn't take much to get on the naughty list there. So what does this mean exactly? Well, prior to 2014, employers could just send a very generic response to an unemployment claim. And if the person was awarded benefits, they could appeal it and then put in the effort later to gather all the details and supporting documents for the hearing. If they were successful in getting the decision overturned at the hearing, the state would then owe the money that had been paid out already back to the employer, regardless of any fault that they may have had in the state making an incorrect decision. Now, post 2014, the states are required to deny reimbursement of those improper payments if the employer has a pattern of doing this. The state may stop paying benefits as of the hearing decision, but you will not get back any of the money that was already paid out. Now, these rules are actually beneficial for all parties involved. If you provide the necessary details and documentation up front, the state will make better initial decisions, which then results in less appeals and hearings for both you and the claimant. And the states are less likely to become insolvent because there will be less improper payments being made. If you think about it like this, an individual could collect thousands of dollars by the time it gets to a hearing. So if you wait till the hearing to provide all of the necessary information that would have initially disqualified the person, the state now has to try and collect all of that money back from someone who is currently unemployed. And now in most states, the employer doesn't get their money back until the state recoups it. I have seen it take 5 to 7 years sometimes, and a lot of times they'll end up waiving that repayment due to hardship. So it really is in your best interest to respond to all unemployment claims timely and accurately. All right, so let's talk a little bit about how unemployment benefits are funded. Unemployment claims are 100% funded by employers, either through taxes or direct reimbursement. It is not uncommon for employees to believe that they pay into unemployment and it's a benefit or an entitlement that they're owed. But this is not the case at all. Now, there are 3 states that do require a small employee contribution that they might see on their paycheck. That's New Jersey, Pennsylvania, and Alaska, I think. However, these contributions, these payroll contributions, go directly to the state for the cost of administering the program and does not contribute to the funding of the unemployment benefits. They are paid completely by employers. So now when it comes to funding these benefits, there's 2 types of employers, right? There's merit rated, which is also known as tax paying, and there's reimbursing, or also known as self-insured. Merit rated employers could be a for-profit company or a nonprofit employer, right? They're going to be issued a tax rate every year in each state that they operate in. And then that rate is going to be applied to a wage base that varies by state. So an example would be Oregon. Their taxable wage base is $52,800. And you could be assigned a rate up to 5.4%. So let's say you're assigned a rate of 4% this year. That means you're going to pay 4% of the first $52,800 that each employee earns. So that's $2,112 per employee. So let's say you have 100 employees. That's $211,200 you could pay this year, regardless of whether you've had any unemployment claims. When determining your rate each year, there are a lot of socialized costs associated with that. So it's not just determined by your own unemployment, usage, right? You could be doing great, but other employers in your state are not. And so your rates could go up due to that. Plus, most states use a look back period of 3 to 5 years to determine your rate. So one bad year could affect you for several years after. Now, the other type of employer, the other type of funding method, right, is reimbursing or self-insured. In order to be eligible for this option, you must be a 501c3 nonprofit organization, a government agency, or a tribal organization. Being a reimburser can be particularly advantageous for several reasons. You're going to pay only for actual benefit payments issued, right? So if you have nobody leave that would qualify for benefits that year, you're going to pay nothing, right? So you're also going to avoid that increased tax liability due to an unfavorable economy, and you'll avoid the tax assessments and socialized costs. Now, I know it seems really scary to be a reimburser during the pandemic, for example, but if you think about it, first of all, the CARES Act was able to come in and sort of relieve like 50% of that, so that was great. But right now, or for the last few years post-pandemic, unemployment has been at an all-time historical lows. And so reimbursing employers are really enjoying the benefits of that, right? Because all the tax-paying employers are seeing their rates and things like that go up because they've got to refund those coffers, those state coffers. Whereas, reimbursing employers only have to pay for the actual benefits that they utilize. So there's a lot more control from that perspective. I like to show this slide because I think it's interesting that, most studies that attempt to quantify the cost of turnover use, usually the formula is the cost of turnover equals the cost of hiring plus the cost of training the new employer, right? But very rarely do they consider the cost of an unemployment claim, and they should, because it is a very real cost that directly impacts your bottom line. This chart just shows you sort of state by state what the different, weekly benefit amounts are, the maximum, and then like the number of weeks that you can collect. And it just shows you, how much one unemployment claim can cost you. Look at the state of Washington. If someone collects all their benefits and they qualify for the maximum amount, one claim could cost you $28,054. So just showing you that it really is something that, even though unemployment is not exciting, it is something that should be paid attention to, and it is somewhat controllable. Not always, but sometimes. Also, slight correction, Massachusetts is showing 26 weeks, but they just recently switched over to 30 weeks. So in the state of Massachusetts, unemployment is very expensive. Okay, so before we get into chargeability and liability, I'll take a quick little pause, check the question box. Okay, nothing thus far. So let's talk about this. One of the most common things we hear in this industry is questions from employers like, why am I responsible for this claim? This person left here a year ago. How much am I going to have to pay on this claim? And so I wanted to walk through how the state does that and what they look at. So first and foremost, in every state, the very first thing that the state is going to do when someone files a claim is they're going to establish something called the base period. So this is an illustration to help you kind of see how that base period gets determined. So the base period in most states is going to be the first 4 of the last 5 completed quarters. Now, there are 2 exceptions, Massachusetts and Minnesota. They use the last 4 completed quarters, but most states use the first 4 of the last 5. So when you look at where the arrows are pointing, those unshaded boxes to the right, that would be your filing quarter, which is an incomplete quarter, right? So we're in the month of May. That's that second box down there on the right. This is not a completed quarter. And so the quarter prior to this one doesn't count. It's called the lag quarter because it's the first 4 of the last 5 completed quarters. So your base period right now, if someone filed a claim today, you're looking at calendar year 2024. So someone who left your company in February of 2024, you're still going to get a claim and potentially be liable for that claim, depending on your state, right? Because you're in that base period. Now you might be wondering what the point, pardon me, of that lag period is, like, why the lag period, this sort of empty quarter. And because Massachusetts and Minnesota, it might seem like what they do is less confusing, but actually it's the lag quarter has a very specific purpose. So every quarter, the employer has about 30 to 45 days roughly to report all of the wages to the Department of Labor. So if you don't have that lag quarter and someone files really early in the next quarter, they're not going to have the wages. They're not going to have all the information that they need to determine the financial liability on the claim. So in states like Massachusetts and Minnesota, when that happens, they have to send this very annoying, cumbersome wage questionnaire to the employer that they have to fill out because they don't have the information yet. So just know there is a very specific purpose to that lag quarter. All right, so so what is the base period? What is the purpose of this, right? So the base period is going to do a couple of things. It's going to tell the state, has the claimant met the minimum wage requirement? So they're going to look at all wages reported during that period to determine if they've worked enough and met minimum wage requirements. It's going to tell the state how much the claimant is eligible to collect and for how long. It's going to tell the state which employers will receive a claim and what type of claim they're going to receive. And if the claimant is found eligible for benefits, it's going to tell the state how much each employer is going to pay. So as you can see, the base period is extremely crucial and the underlying foundation of chargeability and liability for unemployment benefits. So let's go through a specific example. In looking at this graphic, you'll see that there are 3 companies involved in this claim. Okay, we've got company A. So just kind of looking at the bottom row here of this new graphic, you'll see that you've got company A is going to be both the last employer, so the most recent employer, but they're also a base period employer because you can see their box goes into that base period there just a little bit. So they're going to be both the last employer and a base period employer. Company B is going to be a base period employer only, and company C is also going to be a base period employer only. They are not the most recent separating employer. So company A is going to receive a last employer claim, and this claim is the one that's used to determine an individual's eligibility based on their most recent separation. This employer will also receive a base period notice because they have wages in the base period. So the base period notice will address their financial liability. Now, companies B and C are only going to receive a base period notice letting them know that they have liability and will be charged their share if the claimant is found eligible based on their reason for separation from the most recent employer. In most states, if you're the base period employer only, those claims are not protestable, no matter why they left your company. And the reason for that is because, and this is for specific to reimbursing and nonprofit employers, we talked about those socialized costs that go into the tax system, and you're paying all that money, whether you've used it or not. There's like a pooled fund. And so the way that it works for a taxpayer is if this person is found eligible based on their most recent employment, the tax-paying employer can protest the base period claim, like if the person quit or was fired for misconduct. And then the state just won't charge those charges against their experience rating, but that person is still going to get their payments. They're still going to get all their benefits. They're just going to take that employer's portion out of that socialized pooled fund. Well, when you're a self-insured employer and a reimburser, you don't pay into that socialized pooled fund. So there's no money to pull it from. And the state doesn't penalize people for stuff that happened, a year ago. So if this person got fired for misconduct from your organization, they didn't file a claim, they went and found another job and they worked there, and that employer legitimately lays them off and they're eligible, the state's not going to penalize them, because that's not, the separation that caused them to file the claim was legitimate. And so you will have to pay your share in most states. I can tell you, I can't go through every single state example, but I will try to walk through there's like three main types of charging, right? But I can tell you that 36 of the 50 states charge proportionately, which is what this example here is. So in this example, the wages reported by these three employers was $50,000 in total. So this person made 50, we're going to still use May as the filing quarter. So if person files right now, base period's calendar year 2024, they made $50,000 that year. So if the claimant's found eligible based on their separation from the most recent employer, their weekly benefit amount is going to be about $480 a week. So each employer is going to pay their portion of those benefits based on the proportion of wages they were responsible for. So as you can see, even though company A was the one that, let them go, laid them off, made them eligible, right? They only paid, they were only responsible for 10% of the wages, or $5,000. So they're only going to be responsible for 10% of the benefits in proportionate states. Okay, so 36 of the 50 states. So they're only going to pay $48 a week of this claim. Company B was responsible for 40% of the wages, or $20,000. And so they're going to be responsible for 40% of the benefits, or $192 per week. And then company C was responsible for 50% of the wages. And so even though they left that employer, a long time ago, they actually have the biggest chunk of the liability, right? They're going to pay $240 a week of the $480. Now, the other two common charging methods are, there's one called inverse chronological order. I know that Massachusetts and Iowa do that. And that is where they're still going to come up with this same calculation. But what they're going to do then is charge the employers in order of employment, starting with the most recent one until they hit their max liability. So let's just use this example. Company A was responsible for $48 a week. So take 48 times 26 weeks. So they're responsible for $1,248 on the claim. So the state would charge company A $480 a week until they hit the maximum of $1,248. And then they would move to company B, do the same thing. And then if the person is still unemployed, they'd move to company C. Now, I'm going to be honest, I think that this charging method's probably the fairest, makes the most sense to me. But there's only a few states that do this. The other charging method is that they charge the last 30-day employer 100% of the benefits. So Illinois is one of those states. Now, there is a slight exception for reimbursing nonprofit employers. They actually get a little relief if you didn't have wages in the base period. So If you're the last 30-day employer, but that you separate that person really quick, because you know that they're not working out or whatever, and they file a claim and you're the last 30-day employer, but you don't have any wages in that base period yet because it was so new, you're only going to pay 50%. But if you're the last 30-day employer and you have any wages, so like in this example, company A would be responsible for 100% of the benefits in a state like Illinois. So if you're not sure how your state charges and you're curious, feel free to email me on the side. I don't know all 50 states off the top of my head. I know a lot of them, but like I said, the majority of them are going to charge proportionately based on the wages that you paid. So I did mention about reimbursing employers and their base period protest rights. So if you're not the last employer, there are exceptions. There's always exceptions. So the next two slides, I'm not going to go through them in detail, list all the states that have an exception to this rule. So like the state of Iowa, you can protest all base period claims, even if you're a nonprofit. It's very generous of them. States like New Jersey, you can protest base period claims only if it's gross misconduct, like violence, theft, fraud, something like that. And then you've got states like Pennsylvania, which give you a one-time opportunity every year to sort of buy into this pooled fund. So like if you're a reimburser nonprofit, every November, they're going to send you a notice that says, hey, if you want to pay the solvency fee, this is a one-time fee. This will give you the right to protest only the protestable claims, mind you. So you still only buy the right to protest like voluntary quits and misconduct discharges. But you basically are sort of paying a one-time fee into like a socialized pool. So that buys you the right to protest those base period claims when you're not the last employer. Now you need to evaluate what your historical claims look like. And if they're typically like lack of work or, inability to perform job, things that are going to result in unemployment anyway, probably not worth paying that fee. So definitely evaluate that solvency fee if you're in the state of Pennsylvania before making the decision to pay it. And I will say during the pandemic, anybody who paid that solvency fee was loving it because they got relief of charges completely for a certain period of time. So it did work out in that case. But you can't predict those kinds of things. Okay, so we are going to now move on to the types of separations and effective adjudication strategies. So let me start off by saying that the time to win an unemployment claim is not when you receive notice that the claim has been filed. The time to win is before that person ever separates from your company and files a claim, because once they've left, it's too late. You can't go back and ask for that written letter of resignation. You can't go back and create a timeline and the proper warning structure and those sorts of things. And so this part of the presentation is going to focus on winning the claim before it's filed. What type of details is the state looking for? You cannot win every claim. There are a lot of things that seem unfair in the unemployment laws. But what I want to do is arm you with best practices so that you can win the claims that you should be winning, right? Unemployment is extremely gray. It is not black and white. Every situation is going to be different based on the specific details of that case. So I want to just kind of walk through that process and sort of how the state thinks about it, what they're looking for. And this will give you a better handle on how to effectively manage some of your claims, I think. So there are 3 types of job separations that are recognized in unemployment adjudication. And every separation is going to fall into one of these 3 categories. The type of separation, once determined, is going to dictate the flow of how the claim is adjudicated and who has the burden of proof. Now, the state's going to determine which category it falls into by looking at factors such as who was the moving party that initiated the separation, was continuing work available, right? Now, some of these things may seem very self-explanatory, right? I mean, everybody knows what a discharge is, but what you may not realize is things like suspensions and mutual agreements while technically not a discharge, they are going to be adjudicated as a discharge because of those factors I just mentioned. So like a suspension, who's the moving party in separating the person from work? It's the employer. Okay. The employer suspended them. Therefore, the employer has the burden of proof and they are the moving party. It will be adjudicated as a discharge, even though it's not technically one. Mutual agreement. Well, you guys agree to part ways. Things just aren't working out. But the question the state's going to ask is, would continuing work have been available if this person hadn't quit? Essentially, were you going to fire them anyway if they weren't, if they didn't agree to voluntarily leave? If the answer is yes, it's a discharge. Voluntary quits, right? Leave of absence. That's not, you didn't technically quit, but usually it's the employee initiating that separation, and therefore leave of absences will be adjudicated as a voluntary separation. And then you've got lack of work. The obvious ones would be like a layoff, a furlough, reduction in hours, that type of thing. But what you may not realize is that temporary work, seasonal work, contract work, part-time with fluctuating hours, all of those things fall into lack of work. So now we're going to dive into each of these three categories. All right, let's talk about discharges first. And once I get through separations, I will check the questions box again. Okay, so in the event that you must discharge an employee, the burden of proof will be your responsibility. Now, earlier we discussed that unemployment is for individuals who find themselves unemployed through no fault of their own. In the case of a discharge, the employer will need to prove that the employee was separated for misconduct in order to be relieved of charges. And you may have your own definition of what misconduct is, but the state generally defines misconduct as a deliberate and willful disregard of an employer's interest or repeated violations of a known company policy. So keep in mind that it is very possible for someone to be discharged for cause and it not meet the state's definition of misconduct. So you might have made a good, solid business decision to separate an employee, yet they may still qualify for unemployment benefits. So what I want to do is walk through the discharges that are typically going to be a little trickier and often are not considered misconduct. Sorry, I had to take a sip there. Okay, so the first one we're going to start off with is an isolated incident. So an isolated incident is when someone is terminated for a policy violation, but they didn't have any prior warnings for a similar infraction. So the state is typically going to want to see at least one prior warning for a similar thing, right? If they don't see that and it's not gross misconduct, so something really serious, they'll often rule it as an isolated incident of poor judgment, right? The person had to have been warned at least one prior time so that they know they do this specific thing again, they could be discharged. This often comes up when you have a progressive discipline policy that requires termination if they get too many warnings in a particular amount of time. And then it just so happens they're all for different things. So, maybe they had a couple warnings for attendance, and then maybe they had a uniform or dress code violation. And then maybe the final incident that resulted in termination, was disrespectful behavior or, violation of the social media policy, right? Yeah, this person's probably not a great fit for your company because they got a lot of issues, but unfortunately, that final incident, they've never been warned for it before. A lot of times, you're going to have a hard time with those. Now, your policies are your policies, and they're there for a good reason. So it just is one of those things that you can't control. So take a deep breath and let it go. All right, the next one's going to be good faith error. So this oftentimes is when someone violates a policy, but they thought they were doing what was in the best interest of the company. So maybe they made an error in judgment on that, but they really thought they were doing what was right. And, sometimes this could be something that they had no prior warnings of, but maybe it was, something that would result in immediate discharge. Or maybe I've even seen them have warnings, and it's still not work out. And so I have a pretty good example for this. I used to work for, handle claims for a very, very large retail employer that all of us would be familiar with. And they are very sensitive to, lawsuits and penalties and regulations and things like that. And so they're very careful about their policies. And one of their policies is meal breaks, because it's state law in most cases. The people are required, hourly employees are required to take meal breaks and things like that. And so we've seen employees who've gotten fired for multiple meal break violations and it not be misconduct, because if the person says, well, we were shorthanded that day and we didn't have enough cashiers and the customer line was out the door and there was no one to relieve me and we were just so busy and I was just trying to serve the customers. You can see where that employee had no ill intentions against the company. They just, felt like they had no choice but to make sure that the customers were getting served, but they violated the policies and they have to be terminated, right? That's going to be a good faith error. Another thing, now a way to like sort of flip that over is, let's say they've been warned a couple times about this type of thing and you have given them strategies for handling that situation. So maybe they have specific protocol to follow if there's no one to relieve them. Maybe they're supposed to call a manager to the front. Maybe they're supposed to, whatever it may be. If in your prior warnings and coaching process, if you have given them strategies for how to manage that situation and they chose not to follow that protocol, well, now you have misconduct because, they've been warned many times. They knew that another violation would result in termination. You gave them strategies for how to manage and get around sort of those like I couldn't help it situations and they chose not to do them. Now you've got misconduct. So you can see how it really flip-flops back and forth, and sort of what the state is looking for. It's really about intentions, right? The next one I want to talk about is attendance. Super frustrating because we really need people to show up for work, and we've all got those employees that are like habitual, call-ins. They're just calling in all the time. They've always got something going on in their life, right? But unfortunately, it usually is going to come down to the final absence that resulted in their termination. There are some states that, if you have a points policy, a no-fault policy, sometimes they'll give you a go on that one. But for the most part, if the person was sick and they properly reported it per your policy, it's going to be beyond their control because people can't help when they're sick, right? You can't come to work when you're sick. Doesn't matter how many times you've been sick before. The key there, though, is did they follow the policies? So if your policy says, if you're sick, you need to call us at least 30 minutes before the start of your shift, and you need to talk to your direct manager, and this person waited 2 hours into their shift to call, or maybe they texted a coworker and said, hey, can you let Bob know I'm not going to be in today, or something to that effect, right? That would be a policy violation. Those are things that they have control over. Can't control being sick, but you can control how you handle it. And so that's really what the state's looking for. If you've got people that are just late all the time, and maybe it's because they say you really do need to be documenting the reasons that they're giving, because the state will ask you for them and they do matter. So maybe this person says they overslept. Maybe they forgot to charge their iPhone and the alarm didn't go off. That's within their control. They can, if they've got prior warnings and they knew that further attendance issues would result, or, lateness or tardiness or whatever would result in their termination, and they didn't take proper, measures to make sure they can get out of bed in the morning, that's within their control. So you can kind of see there what the state is looking for. They're looking for whether the person could control it or whether they couldn't. All right, so let me talk about the last one here. And then I'll check, I see some questions in the questions box. So let's talk about poor performance. That one gets a slide of its own. I would say one of the more confusing, if not controversial, separation issues surrounds a worker who is discharged due to poor performance issues. But an easy way to think about this is wouldn't versus couldn't. So the worker wouldn't do the job or the worker couldn't do the job. The state feels that it's an employer's responsibility to choose the right qualified person for the job. Warnings will not make a performance issue misconduct. So if the employee has never been able to meet your performance standards, it will be deemed inability to perform the job and they will get unemployment benefits. Now, there are situations where a worker's been performing at an acceptable level and then develops performance issues. That's a different matter. If the worker's job duties have not changed, so like they didn't get a promotion or something, if their duties have not changed and you can show through previous performance evaluations that the individual historically was able to perform the job to acceptable levels or to your standards, this then could be considered misconduct, right? The key is you're going to have to prove that the individual had the ability and is for whatever reason choosing not to perform to your standards. Now, in this instance, I would actually recommend that you do not present it as performance at all. As soon as the adjudicators see the word poor performance or unsatisfactory performance, their minds get closed and their checkbooks get open. So it's usually better if you can focus on a policy violation that occurred in the final incident. So I think what happens a lot of times is that poor performance is sort of used as like a catch-all or like this just like umbrella code that like everything falls into. It applies to everything, right? Um, and or maybe your HIRS system just doesn't have a lot of codes and you didn't see anything else that applied, so you picked unsatisfactory work performance. That's fine. Here's what I'm going to tell you. The state is not going to come in and audit your HIRS system or how you coded the separation in your system. What they want to know is the details. What happened? What was the final incident? What policy was violated? Did they have prior warnings for a similar infraction, right? That's what they want to know. And if there was misconduct or if there was a policy violated, it doesn't matter if your system says unsatisfactory work performance. Look up the details that are documented in your records of what the final incident was, apply it to a policy, send the prior warnings and say, it was a violation of company policy. Now, if it's just really one of those things where you just can't stick it to a specific policy, then change the language you use. Call it deliberate performance issues or misconduct related performance, something to that effect. And then you're going to want to show and say, on these prior occasions, they were performing their job up to standards. Their job has not changed. Here are the issues that we've seen. Here's how many times they've been coached. Here's their performance plan, whatever, right? But again, you're just trying to show that this was deliberate and it's not that they're just not a good fit for the job, right? So let me give you an example to sort of illustrate the difference between what might be misconduct versus poor performance. So say you hire somebody and part of their job requires them to drive a company issued vehicle. And you have a policy stating that a certain number of accidents will result in termination, rightly so, right? Well, it doesn't matter how many accidents this person may have had. You can never prove that someone intentionally crashed the car, into another car, right? Or into a light post or whatever. They're just not a very good driver. So you hired someone to drive a car and they're not a very good driver. Now, on the flip side, if this person was texting while driving, maybe they fell asleep at the wheel because they took some cough syrup because they felt a cold coming on, right? Something like that. Anything that would have caused the accident that would have been a policy violation, then you want to focus on that, not their lack of driving skills, right? Not the fact that they had 3 accidents and that was in your policy, because I can tell you that's how most employers are going to respond. It's they had all these accidents, and in the third one that resulted in termination, the employee admitted to falling asleep at the wheel because they had taken some cough syrup, right? And we know, these in our policy, they're not allowed to take any sort of anything that would cause drowsiness before they report to work or before they start driving a vehicle. I don't know, I'm just making stuff up, but you get the idea, right? Key terms matter as well. So another example, I said when they hear unsatisfactory work performance, it's like cha-ching, they're going to start paying benefits. There's a lot of words you should avoid using. Anything that would imply that it wasn't on purpose or that, it was within their control. It wasn't within their control, right? We had I had another customer years back that had a call center. Thought this one was really interesting. They had terminated an employee for a policy violation called call avoidance. So they were a customer service rep in a call center. Their entire job is to answer incoming calls. This person was deliberately not answering the phone. They'd been warned before and they were fired for it. The former employee was disqualified for benefits. However, the former employee appealed it, went to a hearing, and when we got the hearing decision back, the state overturned it in the employee's favor. And in there, the text said, the reason for the decision, it said, by the employer's own admission, the claimant's, quote, mistake was staying away from the phone too long. So now it turned from Jimmy was deliberately not taking incoming calls, which is his job, to oopsie, Jimmy accidentally stayed away from the phone too long. And I know that sounds a little silly and kind of trivial, but that's literally how the state views this kind of stuff. They are literally just looking at a manual that says, if this scenario applies, rule this way. If this scenario applies, rule this way. And they are looking at the words that you use. They're looking for key terms. The last thing I'm going to say about unsatisfactory work performance, if you identify early on that a worker is not going to be physically or mentally able to perform the duties for which they were hired, it's probably best to separate them as quickly as possible. Now, this is just a tip. I'm not telling you how to run your organization, but if you remember, when it comes to controlling unemployment costs, if you separate quickly, you may not have any liability on the claim, or you might have very little liability on the claim, because when we talk about the base period, kind of that lag period and sort of how far that goes out. So like, let's go back to company A in that example. They may not have separated the person super quick, but they separated them quick enough that they only got to pay $48 of the $480 a week. So just a tip, Plus then you can maybe hire somebody else who will actually be able to perform the job to your standards. So win-win, right? You save money, you get a better employee in the end. So just to finish off discharges before I check the questions box, what type of documentation, like what is the effective documentation? And I've touched on this throughout my talking points here, but I'll reiterate. In order to be compliant with the state and in order to provide sufficient information to properly adjudicate the claim, you need to first and foremost, of course, dates of employment. That's not even on here. That's just a given, right? For everybody, all separations, dates of employment. First day worked, last day worked. That's a given. But then you're going to need to provide the date and details of the final incident. Focus only on that final incident. Do not give an entire, speech about, 7 paragraphs about everything this employee ever did and what a terrible person they were. That's not what they want. The state actually wants you to say, okay, here was the very last thing the person did that triggered us to say, yep, we're going to terminate them. Do not include stuff that happened before and do not include anything that happened after that decision was made. So like, for example, if you tell them that they're being fired and they get mad and they kind of throw a chair across the room violently, honestly, even though that, you can add that in later for like, character, just to kind of show the person's character, but do not include that as part of the final incident because that happened after you made the decision to terminate them and it is irrelevant to the final incident. Then you're going to have to tell them, okay, what policy was violated, right? Was it progressive discipline? Was it, a specific policy? What was it? You're going to need to provide a copy of it so that the state can see if you are following your own policies. I'm going to tell you that sometimes we as employers think we're being super nice and that we're going to get credit for that, for being extra generous. So like, even though you aren't going to win a lot of attendance cases anyway, we'll just use that as an example. Maybe you think it's going to look The state's going to look fondly upon you because you're like, look, I gave them 10 extra chances than even what our policy said. Like, we really tried to work with this person and they still, whatever. And then we had to fire them. Actually, that works against you because the state looks at it as like, well, if you don't even follow your own policies, then how do employees know what's expected of them? So you've got to follow your own policies, and the state will be checking that. And then you need to provide acknowledgement of the policy. So how did the person, how are they made aware of these policies? Did they sign a handbook? That they got acknowledgement of a handbook? Did they take a little online quiz when they first started? Just some way to prove that they should have known that it was wrong, right? And then last but not least, now you get to provide all the history through prior corrective actions and warnings. So we talk about the final incident. That's one thing. Then you get to go back and say, okay, here are all the things that led up to it, and these are the corrective actions that we took. The last thing I have on here is witness statements, but I'm going to tell you that I wouldn't include those unless you're really comfortable with it. Anything that you send to the state for an unemployment claim will be public record to the claimant. And if you're worried about retaliation, so say someone wrote, a witness statement, and it's, an hourly coworker of theirs or whatever, that person's going to see their name. So if you're concerned that that person may go find that person out, and retaliate, it's better just not to send them. Redacted witness statements are they're not useful. So don't try that. Plus, a lot of times the claimant will know who is listed in that redaction just based on context. So just be very careful about witness statements. They're not required. The top 4 things that are listed there on this slide, those are the things that you really need to provide. Witness statements are just helpful if it's if it fits the situation and if you're comfortable with it. All right, so that's going to wrap up discharges. I got questions in the question box, so let's check those out real quick. Okay, so there's a question about lack of work, and I think I'm going to cover that in just a moment when I get there, so I'm going to table that one. Let's see, with burden of proof, you said it must be deliberate. And what was it needs to be a deliberate and willful disregard of an employer's interests or repeated violations of a known policy, a known company policy. So that is the state's definition of misconduct. Another question, if on warnings we use verbiage such as, if new situations arrive, will that consider as being warned before terminations? Yes. So you want to use yes, but again, if it's that mixed bag situation where the final incident, you can try that. It's going to depend really on how closely, like, the state is going to make a decision on, would this person have reasonably known that whatever they did was going to result in them being fired? So that's a little tricky. I would definitely put the language in there, and certainly use language like up to, next violation is up to and including termination. Absolutely use that language. It's very helpful, but it's very, very gray. It's going to come down to, if they had no prior warnings for a similar infraction, you're really going to have to show that this person knew that what they did on the final incident would have resulted in their termination, like that it was going to, apply to this. And again, it's going to just depend on the adjudicator of the state and how they view that. But yes, putting language like that in your counseling and your warning paperwork is super important. Let's see. We recently let somebody go due to time card fraud. It is defined as gross misconduct and subject to immediate termination. We found 4 instances of time card fraud in 2 weeks and terminated this person upon checking the 4th violation. No prior warnings given. Is this a legitimate? Yes. So anything that could be like theft, which this would be company theft, time theft, right? Time clock theft. Anything that would be considered gross misconduct in the state size, which is usually going to be theft or violence, fraud kind of falls into that theft. If you can prove it, right? You got to prove it. But if you can prove that this was happening, you don't need prior warnings. I would say, though, that most situations will not be considered gross misconduct. Something like this definitely sounds like it could be, and would be a legitimate gross misconduct claim and would not require prior warnings as long as you can prove it. Okay, so that's all the questions in there for now, except for the lack of work one, but I will again come back to that here in just a little bit when we get to lack of work. Okay, so voluntary quits. These are a lot easier, guys. So burden of proof is going to be on the former employee. They've got to prove that they quit with good cause attributable to the employer. And then they also are going to have to show that they exhausted all reasonable options before making the decision to quit. So what are some things that could be good cause? So a change in the condition of their employment, right? That would be a good cause. So if you hire someone to work particular pay, particular hours, and you change that significantly and they don't want to make that change, that could be a change in the condition of their employment. Or, you know, a lot of nonprofits are very small organizations where people hold multiple roles or they fill in for other people. So maybe you hired Sally to be a bookkeeper, and Sally's very shy. She's a bookkeeper for a reason. She really likes to not talk to people. She's very nervous and uncomfortable in talking to customers or strangers, you know, in a work setting. And maybe your receptionist quit without notice and you're like, hey, Sally, we really need you to cover the phones a couple, you know, days a week until we can get a new receptionist in. And maybe Sally's just really uncomfortable with the idea of that. And that was not in her original hiring agreement. Now, you can ask Sally to answer the phones, but if Sally doesn't want to answer the phones and you're telling her it's answer the phones or nothing, right? You might be forcing Sally to quit and she would have good cause. So those are some examples. I don't think things like this come up very often, but just know that would be considered good cause. Changing the condition of their employment. A significant pay decrease would be changing the condition of their employment, right? Depends on how significant. Things like harassment or hostile work environment could be a compelling reason, but know that the employee has to have reported it to you and allowed you appropriate time to resolve the situation. And even if you didn't resolve it to their satisfaction, like if you've taken appropriate measures and you've documented that situation and the things that you did to make that person uncomfortable, to make them comfortable or to remove the hostile situation at hand, whatever it may be, if that person still chooses to quit, that's not going to be good cause, right? They're not going to have good cause for quitting because they didn't exhaust all options. You know, if they didn't report it to you, if they just quit and said, oh, I was being harassed, it was hostile work environment. If they didn't report it to you, definitely didn't take all reasonable measures. And if they did report it to you and you've taken all steps to resolve it and they still decide to quit, again, that is not on you, that is on them. So the burden of proof really is on the former employee. Now, as with always, there are some exceptions. They vary greatly by state, but for the most part, there are some ones that are going to be pretty similar across the nation. And those would be things that we would consider quitting for good personal cause, and the state's going to allow them to collect. So some of those examples would be if they have a military spouse and that spouse gets moved to another state, and if this person took all reasonable measures like requested a transfer, requested remote work, and none of those things would work out and they have to quit and leave, as long as they're meeting all the criteria in their new location, you know, searching for work, proving that they're looking for work, those types of things, the state is often going to allow them to collect because they're not going to separate families like that. And this person is serving their country. So just keep that in mind. Another one of those examples would be like domestic violence. So if someone has to leave the area because of a domestic violence situation, as long as they've asked for these like transfers, whatever, remote work, again, that might be something that would be a regulatory quit that the state might allow them to collect in those scenarios. So just know that those things do come up. And then the other thing I want to say about quits, and I mentioned it earlier, continued employment must be available. A forced resignation equals a discharge. So again, the state is not going to come in and look at your records to say, oh, nope, you told us it was a discharge, but I see in your records here you put voluntary quit. They're not going to do that. They want to know what actually happened. They don't actually care about your codes. So if you and this person are like, yeah, this is not working out, we're going to allow you to resign for the record instead of being fired. that's fine. You can do that. But just know if they file for unemployment, you're going to have the burden of proof as a discharge. If it is your intent to try to get them disqualified, you're going to have to prove misconduct. It's not a voluntary quit. So what kind of documentation do you need for quits? Quits are, again, a lot easier. Really, all you need to be compliant with the laws is dates of employment and the reason they gave you for quitting. If you supply that, that's enough. Now, I will say, though, if you really want to have a good chance of winning the claim, letter of resignation. Doesn't matter if it's a text, an email, a formal letter, anything in writing that says why the person is quitting. Okay. Exit interviews are great. If you have exit interviews that show, sort of that thought process behind why the person was leaving, those things are really helpful. But again, they're not required. You just really have to give dates of employment and the reason the person quit. Notice periods. If someone gives you notice and you're like, yeah, we appreciate the 2 weeks, but your employment ends today, just know that the state will allow them to collect for that notice period that you didn't let them work. Doesn't mean they're going to collect after that, but they will 100% be allowed to collect for that notice period. So just keep that in mind. The state's also they're going to ask if the person gave notice and whether or not you allowed them to work it out. So in those scenarios where they ask for that, that's why they're asking, and you should be prepared to give that information. So please make sure that you document that. In terms of like job abandonment, so no call, no shows. Here's the deal with that. Most states are going to require 3 consecutive no call, no shows for it to be considered a voluntary quit or job abandonment. There's 2 states I know of that require 5 days. That's Alabama and New Jersey require 5 days of no call, no shows for it to be job abandonment. Otherwise, it's a discharge for attendance. So just keep that in mind. If you can, even if you've already sort of mentally made the decision, this person no call, no show, we're totally like they're done for. If they just never come back, document the 3 consecutive or 3 to 5 consecutive shifts that they didn't call or show up for, and then you can present it as job abandonment. They just abandoned their job and they never came back. Now, if you're going to go the attendance route, you're probably still going to be okay as long as they had prior warnings, because not calling in for work is considered a policy violation. So again, you're probably going to be okay in most scenarios, but anytime we can put the burden of proof on the former employee, that's going to be best. Okay, so now let's talk about lack of work. Okay, lack of work is the intent of unemployment, right? I mean, it's the entire reason that this was brought up, or why the whole program was made. It's not disqualifying, okay? If you eliminate someone's job, if you do a reduction in force, if you do a furlough, those are pretty obvious. Person's going to be collect, and we want them to be able to collect. But there are some scenarios that fall under lack of work, and there are some things that we can do to control some of those costs. So I want to walk through those things. Now, if you have, I think, let's go up to the question queue, because I think the question was about contract workers, so I want to make sure I address that. Could a person be hired as a temporary or contracted for a specific amount of time and still receive unemployment when the time ends? Yes, 100%. As long as they're meeting all other criteria, they're still looking for work. If you're not offering them more work, it's lack of work, and they are eligible to collect. It doesn't matter that you told them it was for a specific amount of time. You could be hiring Christmas help at the mall, and when that job is over, they could be eligible to collect. And that is because the state is not going to discourage individuals from accepting work, temporary or otherwise. So they're not going to say, just because you accepted a job that was only for 3 months, we're now going to disqualify you when that job ends. No, I mean, if they're still looking for work when that job ends and there's no work available, it's a lack of work. So know that hiring temporary contract employees is a cost of doing business. Now, independent contractors are different because independent contractors are not employees. Now, I'm not even going to get into the definition of an independent contractor because that's out of my scope of expertise, but be careful with independent contractors. That's all I'll say, is make sure your state Make sure you're following the laws of your state for what is truly an independent contractor, because believe me, it's not what most people think. But independent contractors are different. You don't report their wages to the state because it's not covered wages, because they're not an employee. But if you bring them on as a contract employee and you dictate their hours and how much they work and all of that, they're an employee, and yes, they will be able to collect. So hopefully that answers your question. I think there's another one here about lack of work, so let me read this one. We recently let an executive go and offered pay and health benefits. There was a contract signed at the time and made it appear that it was a voluntary quit to the whole org. If this person applies for benefits, we need to prove that it was not a forced quit. Yes, if you ask me, it sounds like a firing. It doesn't sound like a voluntary quit at all. I mean, if you're doing a separation agreement and you're offering to pay them, pretty sure it wasn't a voluntary resignation. So however, though, if you're paying them, so if it's like, it depends on how you code the pay, but if it's ongoing salary continuation, in most cases, they're not going to get unemployment until that pay ends anyways, because they're making money, right? So, but yeah, if you stop paying them and they apply for unemployment, you're never going to get away with that being a voluntary quit. That's definitely going to be a discharge. Good questions. Yes, thank you. I just now scrolled down and said that you clarified it was not voluntary. Yeah, you're going to have to show it's going to be a discharge. So you might as well just say that you let this person go for whatever reason. If you're not even worried about disqualifying them, then you can just provide basic details like it's just not a good fit for the position. It just wasn't working out, that sort of thing. They'll be eligible and whatnot. Otherwise, be prepared to prove misconduct. Okay, so let's talk about the things within the lack of work bucket that you can control. Okay, so the first one, let's talk about, I say control, but there are parts of it that you can control. So let me start here. There are 3 things that you can protest under the lack of work umbrella. Those things are going to be regular part-time employment in most states, availability or job refusals. They kind of fall in the same category. So availability or job refusals. Those are the 3, like those are the main things that you'll be able to protest. And then some summer camps or seasonal camps. So I'll get into those. I'm going to talk through all 3 of these really quickly. So regular part-time. So the state defines regular part-time as someone who is working less than full-time, but works the same schedule every week. So if you have someone and you hire them to work Monday, Wednesday, Friday, 9 to noon, and that doesn't change, that's regular part-time. Regular part-time in most cases is protestable. We hired this person for a schedule. This is what they wanted. There has been no change in employment. There you go. Now, the second definition, which probably more applies to the majority of you, is part-time working all available hours. So this means they work less than full-time, but their hours vary week to week, depending on business needs. Okay. Now, if this person is not putting restrictions on their hours, they're accepting all work available, and their wages fall below a certain amount, they will be eligible to collect. So let me give you an example. Let's say someone works somewhere else. They have a primary employer that's responsible for most of their income. And then they work for you part-time. And, they're accepting all the work that you're giving them. And something happens with their primary employer and they go file a claim. Now, first of all, don't take it personal. They're not filing a claim against you. It's not like they, went online and said, I'm filing a claim against the YMCA or whatever. That's not what they're doing. When they file the claim, you remember the base period, the state's going to look at all the employers that paid them wages. So you're in there. You're going to get a claim. Okay. So they're just probably trying to make up for the income they lost from this other job. So the way that works is the state is going to determine how much they're eligible to collect per week. Remember, it's about 50% of the average weekly wage that they earned during the base period. And then the state's going to say, okay, every week, since you still have some employment, you're going to have to report your wages. And if it falls below a certain threshold, you'll get a partial benefit. And then if you're in a proportionate state, every employer you could be one of them, is going to pay their portion. So yes, if this person is working for you part-time, you could still be paying a partial unemployment benefit. This happened a lot during the pandemic because everybody lost like their full-time employment, and then some of the other ones were still providing part-time, and it caused a lot of questions, a lot of frustration. Why is this person claiming against me? Why am I paying when I'm still providing work? So the key here is if someone files a claim and it's because they lost another job or whatever, start offering them more shifts. Okay. If they make a certain threshold, a certain amount of wages, they're not going to collect a partial unemployment benefit. So in that scenario we gave earlier, $480 a week was their unemployment amount. So they were probably making, they're making $50,000. So divide that by 52 weeks. They were making about $961.53 a week. Their unemployment benefit's about $480. So if you can give them, usually at least their benefit amount, some states have different rules. Sometimes there's like a buffer there, but generally you can give them around the $480 per week. They're not going to collect benefits, or they're going to collect very, very little. The other thing though is when you're offering them more work, if they refuse, so if they don't accept the work, you can report that. And then that would be an availability issue or refusal, and then that will cease their benefits. So really the only way around this, if someone is working part-time available hours for you, is to offer them as much work as you can. And on the bright side, they're working and filling in shifts and they're not collecting, or on the reverse side, they refuse, and you can report availability issues and get a disqualification. Now, remember though, it's on you. So the claim may have come in. So you know what, let's move on to on-call casual, because this kind of applies more to that. You'll get what I'm about to say here. So on-call casual people would be like assignment-based employees. So maybe a substitute teacher, in-home care workers, those kind of things. So in between assignments, if they have enough wage credits that they haven't collected on, right, they will be eligible to collect in between assignments as long as they are actively seeking work and accepting work assignments made to them. Okay. So why I was about to say that you need to document when people are refusing work is, and that it's proactive, is say someone finishes an assignment with you. So maybe they were an in-home care attendant for people with disability, they have special needs or whatever. And they finished that assignment. And at the time when they finished the assignment, you didn't have another assignment for them yet. And so they filed a claim and you responded, assignment completed. That's lack of work, benefits approved, stamp approved, benefits get paid, right? Maybe 2 weeks later, an assignment comes up and you call this person and you offer them the assignment. And they say, yeah, sorry, I'm actually going to be taking a pottery class that week, so I can't do it. Well, they're not going to probably proactively report to the state that they're unavailable because they're doing a pottery class, right? So it's on you to actually send a subsequent follow-up to the state to say, hey, we did respond. It was lack of work, but now this person has an availability issue. Same with substitute teachers. I know it's cumbersome. It's a lot of work to track that, but that's how you control those costs. So like think about staffing agencies. My gosh, they have to do this. Like they have to have like staff that they do nothing but manage this. So for example, what they do is every time they have assignments come up, they look at who filed claims in the last couple of weeks for unemployment benefits, and they use that as a recall roster. So they offer the new jobs to the people that have filed claims first. You can do something similar, right? If you've got on-call people, casual workers, if you've got people that are sort of playing the system and they're going to go in and out of unemployment, use those lists of people who have filed claims and that they're collecting as a recall roster. Offer the jobs to those people first. Okay, so when you're going to protest part-time, we kind of already talked about this. We won't spend a lot of time on this slide. Basically, set schedule each week. Did the claimant put restrictions on their hours? If they have restrictions, you need to have that in writing when they start. And if they change their availability, you need to get it in writing, because you wouldn't believe how many times somebody will say, well, I'm available to work 28 hours a week. And then they want to, do something else or a powder. Now they're like, well, now I'm only available for 18 hours a week. And then they file for unemployment for the difference. Well, you need to get any availability changes in writing because you have to prove that it was their restriction and not a lack of work that caused their wages to fluctuate or go down. Okay. Is the claim, so with availability issues, it's going to come down to, is the claimant accepting all available work hours? Make sure you're documenting refusals. And by the way, I think all of you on this call should be members of our trust. And there's a really good way to do this. It's real easy. We said that a lot of times it's proactive and the claim's already been filed or filled out. Within the Shield platform, so that platform you guys use to fill out your claims, there's a link on the left side menu that says, do you have a refusal of work, or did somebody refuse work? All you got to do is click that link. It's going to ask you all the specific questions of what the state's going to need to adjudicate that availability issue, and then just fill it out and hit submit. And then Thomas and Company will then write the availability protest to the state on your behalf to let them know that this is going on. So it's a really nice, easy way for you guys to submit those availability issues. Okay, so the next one is going to be summer camps. So not all states do this. The ones that we know of for sure that consider summer camp employees exempt from unemployment are the ones that are listed here on this slide, okay? So what that means is if you meet the criteria, so if the person working for you is a full-time student, so they're just like off school for the summer, they're employed less than 13 weeks, and your camp operates for less than 7 months a year, then these are non-covered wages. Just like an independent contractor, you would not want to include these employees on your quarterly reports to the Department of Labor. If you put their wages on your quarterly wage reports and they file a claim when that camp is over, if they're not in school full time anymore or something happened, whatever reason they filed, they could get benefits. So just know, or maybe they, we talked about the base period, it can go on for like 18 months. Maybe they finished the next school year and then they filed the next summer or something like that. And now they're available and they're not a full-time student anymore. If their wages were reported to the state last summer, you're in that base period. So please know your state's rules regarding summer camp employees. Even if your state is not on this list, it might be worth looking it up. I'm not a payroll expert, so these are just the ones that we've run across, but basically what you would want to Google is like, what is considered covered wages for unemployment benefits or subject wages? And you may find this provision for summer camps in your language, even if you're not on this list. So something to keep in mind. The other tip and strategy for lack of work claims is understand the rules for severance in your specific state. I cannot tell you how many times we've had employers say, hey, we paid this person like $40,000 in severance. Why are they collecting unemployment? Well, it's because, sir, your state doesn't consider severance to be deductible from unemployment. Every state looks at it a little different. Know your state. Also, some states, it depends on how it's paid. So whether you pay it as a lump sum payment or whether it's allocated out into multiple payments. So again, structure your separation agreements based on your state rules and what your goals and intentions are. In addition, kind of like the summer camp employees, if your state does not consider severance to be covered wages, then do not report that on your quarterly wage reports. I can tell you we had an employer that did not know that. Again, this is a payroll thing, not my area of expertise, but I only know this because we ran across it. This California employer had separated someone, and it was like a tricky situation. It was complicated. This person didn't get their severance payments until like, I don't know, 3 months after they left the organization. So that's when they were recorded. The employer made the mistake of sending those wages in on the wage reports. Now, California doesn't view severance. They don't deduct it from unemployment. The employer knew that. They were okay with this person getting their severance and unemployment. But here's what happened. After a year was up, so claims are good for a year or until someone hits their maximum liability, right? The year was up and this person filed a new claim. When they filed the new claim, there was a new base period. And this employer should not have been liable. They should not have been in the base period at this point when the person filed. But guess what was in the base period? The severance wages. And this employer then became liable again based on the separation payments they gave this person. So now they had to pay more unemployment based on those severance wages that were deemed qualifying. So they had to go back then and amend and edit their past reports. So again, be very careful. I can't really help you with the severance, the payroll reporting rules in your state. If you're curious if your state looks at severance or not in terms of deducting it from unemployment, that I can help you with. You can reach out to me. But again, just be very careful, know your state's rules, and structure your plans accordingly. Okay. And then last but not least, consider using reemployment or outplacement services. I think our company just did a webinar on our services for that. It's included in your membership with us. These services, you get up to like 20 upgraded coaching packages a year with resume building and job boards and all that stuff, and one-on-one job coaching. It is a great resource. If you have to separate folks and there's no misconduct involved, maybe it was just a layoff or, something like to that nature, maybe it just isn't working out, that kind of thing, but you want to supply them with some resources, reach out to us. Gary Casey here at 501c Services handles our reemployment packages, but it's a great way to sort of bridge that gap for them. And it reduces your unemployment payments because they get back to work quicker. So when they use these reemployment services, they go back to work faster than if they were just finding a job on their own usually, and it will shorten the duration of unemployment. So again, consider using those services. They are there for you to use. All right, tips and appeals, tips for unemployment appeals and hearings. I'm just going to go over these really quick, and then I'll check the questions box again. I know we've got about 9 minutes left. So when you're using our services, we have representation available to participate in hearings with you, and they're going to coach you and go through all of this stuff with you. So if you want a representative to coach you and attend with you, when you get the notice of the hearing, there's like a box at the bottom of Shield that says, do you want a representative? Make sure you let us know right away so we can get somebody assigned to you. But they're going to coach you and they're going to go through all of this, which is why we're not going to spend a ton of time on it. But the main things I want you to walk away with is firsthand testimony is critical. Remember, the claimant is going to be giving firsthand account of what they believe to have happened. So if you just send an HR rep and it was a supervisor that actually witnessed the incident and not the HR rep, that's not going to be firsthand testimony, and it will get lesser weight than firsthand testimony. Okay. Always remain calm. These things can get really emotional because it happens sometimes where the claimant is just lying through their teeth, or maybe the judge is being very biased and maybe they're not, maybe they're really like, you can tell they're just kind of leaning toward the claimant. Stay calm and only address the facts. So what I would say or suggest is when the claimant is talking, if they make a statement that you believe to be incorrect or unfactual, write it down. Have a notepad handy, make a note of it. When it's your turn to talk again, circle back and address that claim. Okay. You do not want to interrupt. You don't want to get like, wait, you don't want to butt in. Okay. Wait till it's your turn to talk. Then you want to make sure that you circle back and readdress that. So make sure you write it down because you might forget in the moment. But don't interrupt. Address only the facts. Be very intentional in how these things are presented. So again, final incident, not an entire, soliloquy on everything this person ever did. It's final incident, policy violated, how they should have known, what was your policy and how they should have known that this was against the policy. And then what was the historical coaching process that led up to this so that they should have known that this would result in termination, and why you believe that benefits should be denied. You definitely, during the hearing, there's going to be a lot of back and forth. Things will get kind of muddied up. So definitely offer a closing statement to the exact effect of what I just said, right? Net it out, be very intentional, be very specific about what you're saying, and just, apply it to what the state is looking for. But again, if you have a hearing representative, they may, you guys might decide that they're going to make the closing statement for you or whatever. You guys can determine that, and they'll help walk you through that and coach you. So, but these are just some things to know in case you decide you want to attend the hearing on your own. And so, of course, my last tip would be to utilize the hearing representation services that are available to you and included with your membership. Okay, so that was a lot of stuff. Let me see if there's any new questions. Okay, if we have another job posting that is similar to the current job and the exiting employee must apply for, would that still be lack of work since they would need to reapply? I'm going to be honest with you. In most cases, no. If you're eliminating their job and you're going to make them reapply and go through an interview process for that job, the state is not going to hold them. Like, they are not going to force them to stay connected to you as an employer when you are terminating their position. Okay. So if you offer them this other job outright and it's similar pay, similar duties, that could be considered a bona fide job offer. And in which case, if they refuse, you can report that. And then the state can adjudicate whether the job similarities were close enough. But if you require them to reapply, and go through that whole process, no, they're not forced to reapply for your company. They are required to prove that they're applying places, but they're not forced to apply for you, if that makes sense. Hopefully that answers your question. Last question. We are currently having to eliminate 2 positions because we get funding sources from the city and other. They have informed us they will no longer be funding these positions. It's not our choice, but based on our funding deficits, would this still fall under lack of work, and what is the best practice to do? Yes, unfortunately, anytime you let someone go because of a loss of funding, a grant, what have you, yes, it will fall under, it's a lack of work, and they will be allowed to collect unemployment as long as they were an employee and had covered wages. Again, it's the cost of doing business when you hire temporary employment or something that could be unstable, such as something that is dependent on government funding. So there really is no best practice, I would say, except for, not hiring those individuals, which probably isn't a really good option either, right? Now, again, you could use those reemployment services to try to get them back to work quicker. So that could reduce some of the liability. If you're in a state that has, severance deductions, you could try that as a way to sort of maybe mitigate, but I don't really know how much that would save you. And if you have other work, another position in your company that maybe isn't dependent on government funding, you could try offering it to them. It depends on how similar it is. And they may or may not accept it, but if they refuse it and it's similar enough and the state thinks it's a bona fide offer, you could get a disqualification that way. So those are really the only ways for you to sort of manage that scenario. So, okay, so that's all the questions that we had. I finished 2 minutes early. That's really good for me because I'm a little long-winded. So anyways, I'm really glad that you guys joined me today. I hope you learned something. Or if you were just here for the HRCI credits or the SHRM credits, that's okay too. Thanks for joining us. Again, if you're looking for those credits, you will get a survey. Once you complete the survey from the webinar, give us 24 hours and you will get a what's it called? A code for you. Sorry. So I do see that somebody raised their hand. I think everybody's like muted and it's like a thing. So not really sure how to undo that, but let me give you my email address again. So it's nkorn@501c.com. So that's N as in like Nicole, KORN @501c.com. So if you had a question and you didn't get to ask it in the chat box, or if I didn't answer it, feel free to send me an email. I'll get back to you as soon as I can. And again, there's a copy that you'll get a copy of the presentation and I believe a recording in follow up to the session. Hope everybody has a great rest of your week. Talk to you soon. Thank you.